Boom. All right, what's up, you guys? It's Royce Jacob. Welcome back to the channel. In this video, we are going to be debating about whether or not another crash is on the horizon for the equity markets. We're just going to dive straight into this one today, you guys. Get straight to the point. But right off the bat, let me know in the comments down below, are you bullish or are you bearish on the equity markets at this point in time? Simple, but interested to hear you guys' take on that. And of course, subscribe to the channel if you're not already. But in front of us is TradingView, where we will be looking at the chart that I personally feel best summarizes the equity markets as a whole, and that is the good old Spider S&P 500 ETF Trust. So good old S&P 500, a basket of some of the largest American companies, which is why exactly I feel it best summarizes the overall US equity markets. We're going to be taking a look at this today. We're going to be zooming out and taking a look, prioritizing the daily candles. I want to show you guys what we're looking like on a year-over-year basis, and maybe going even further back than that. We actually are going to be going further back than that, because that's where this purple trend line comes into play, which is very significant, so stay tuned for that one. But yeah, we're going to be keeping it more macro today, you guys, not only on the charts, but fundamentally as well, because as you know, if you've been tuned in, there are a lot of macroeconomic factors at play right now that I believe, and many others believe as well, it's not like this is a rare opinion, will act as significant headwinds for the markets in the near to midterm future. Okay, so that's that, you guys. Are going to be taking a look at the SPY, not looking at the Qs today, but we'll also be looking at the VIX, or the CBOE Volatility Index. That tracks the volatility on the SPY, and because I'm personally bearish on the S&P 500, I am bullish on the VIX, and I want to talk to you guys a little bit about where I potentially see the VIX going in the case that the S&P sees more downside like I expect it will, okay? Remember, just simple. If the S&P 500 goes up, VIX goes down, vice versa. S&P goes down, VIX goes up, okay? So that's why we're going to be looking at the VIX, just to give you guys an idea of how you can potentially hedge yourself if you decide that, in this debate that the SPY, that the Qs will likely see more downside, okay? So we'll take a look at the SPY, close it out on with the VIX. Next to it, to supplement, this is kind of technicals and fundamentals right here. This is an S&P 500 PE ratio chart. Now, PE stands for price to earnings. Okay, it kind of dictates fair value, or historic fair value, for the market caps of the companies within the S&P 500, okay? We're going to be talking about why that's important relative to where we're standing right now and in this macroeconomic environment that we're currently in. And we'll take a look at historic means and medians, because that's pretty much the most factor that's going to play a role right now in this fundamental / technical argument, okay? So before we get into that, just to summarize my thoughts on the macro, I'm going to read you guys the intro to the newsletter that I sent out this morning, just because it's I spent a good amount of time on this, and I honestly wrote, as I was writing this, I was like, I'm just going to going hard on this, because I do want to give a macro talk in today's video, and instead of just rambling over and over, I want to read my thoughts in a summarized and neat and tidy way. Okay, so let's do that, and then we'll dive into some of the other fundamentals. It's Tuesday, and it's another day of green in the equity markets, Taco Tuesday. It's also another day of my shorts getting smoked. I'm glad that some of my stock positions are offsetting the losses, but I'm definitely still seeing red. So again, your boy's short in the market, your boy's heavily hedged, very heavily hedged, and unfortunately on green days, your boy's not doing so good. But regardless, that's the game. I still have fundamental conviction, and I'm sticking to my guns on this one. And I feel that my arguments from both a rational and fundamental perspective still point to more downside, but hey, you listen to all the arguments here, and again, let me know down below if you agree or disagree with my sentiment. The feeling I have now is very similar to the feeling that I had in the early days of the crypto bull run back in mid-2020. Plays like Riot and Mar were floating around single digits, and Bitcoin was trading in the low to mid-teens. I knew that these things were going to see big moves given the state of the macroeconomic environment. You're going to hear the macroeconomics, the macroeconomy, because it plays such a significant role in this environment with raising rates, etc., etc. We'll get into that below, but I knew that these things were going to see big moves given the state of the macro environment, but it just wasn't happening. And we all know how that one ended up playing out again. Look at December of 2020, look at what Riot, Mar, Bitcoin did, and that's how that ended up playing out. But again, there was a lot of days in early to mid 2020 where I was holding Riot, holding Mar. Why aren't these things going up? $2, $3, $5 at the time. And you just got to play patient. And again, if you have macro conviction, then just stick with it and withstand the volatility. And again, hopefully with the VIX, you can make that volatility play in your favor. But these days, I have a similar macro conviction, but this time it unfortunately isn't bullish, it's bearish. The primary catalyst for the bull runs of 2020 and 2021 amongst the equity and crypto markets were liquidity injections, asset purchases, and the lowering of rates to near zero by the Federal Reserve. Cut to 2022, and each of those factors have been bullish for the markets are now being halted and reversed. Inflation is hot, yet consumer spending is down. Don't fight the Fed was applicable on the way up, and there's no reason that it shouldn't be equally as relevant on the way down. BP, big oil company, just crushed earnings because the price of oil and commodities is skyrocketing. But PayPal and Meta, Facebook, tanked on earnings because consumer spending has slowed so significantly that advertisers aren't deploying capital. As I said yesterday, it's almost immoral to the lower to middle classes of the country for the Fed to not attack inflation with heavy hands. And I think the CPI, or Consumer Price Index report that comes out this Thursday, will expedite that process. It sucks to get slapped in the face day after day when the short-term price action isn't reflecting your longer-term beliefs, but that's just the name of the game sometimes. And keep in mind, you guys, although I'm short the equity markets, I'm still very, very excited for what growth sectors hold. Again, plays like MTTR, VIXY, Riot, Mara, Coinbase, SoFi, Plug Power, a lot of EVs, all the stocks we love around here, all the stocks I'm still very bullish on long term. Obviously, the same principles, the same sentiment, the same way of thinking and a style of attacking your longer term investments applies not only because when I'm short the market, which is what I'm kind of referring to now with my hedges and shorts in place, but definitely on a longer term time horizon with these hyper growth companies that, as we all know, go through boom and bust cycles, and that's once again just the nature of the beast. But again, just remember, you guys, these are base principles. These are fundamentals of investment and trading on a longer term time horizon. That just apply in every scenario, no matter what you're trading. Okay, these are base principles. These are core principles. Hardship builds character and resilience as a trader, and ultimately, if you have conviction and cojones, the red days give you the opportunity to double down on your beliefs and take advantage of the corrections in your positions. Okay, so as always, you guys, plug time if you want one of these bad boys. This is just the intro. I write 2 parts to the newsletter every morning. I work hard on this. If you guys, not that, we'll take a look at that after we take a look at the S&P on the charts, but if you guys want the daily newsletter in your email inbox every single trading day during market hours, along with my entire portfolio, you want to know what I'm trading, when I'm trading it, why I'm trading it. That's what the newsletter is for, explaining my thoughts, explaining the macro, throwing in some charts and whatnot, like you see right here, which we'll cover after this. That's part 2. But if you want one of those, just $15 a month. I feel it's super worth it. I'm obviously biased, but I feel it's very worth it. $15 a month, $40 for every 3 months. It means a lot if you guys check that out. If you appreciate what I'm just doing here, recording daily videos, it's a good way to support me as well. And honestly, I think the product is more than worth it. But again, I'm biased. Regardless, first link down in the description. Really means a lot if you guys check that out. But again, if not, no worries. I appreciate you watching right here, right now. Let's take a look at the SPY. But after that, let's take a look at the S&P ratio. And I'll just give you guys my 2 cents on why I wanted to share this chart with you guys today. Okay. So the S&P 500 price to earnings ratio, again, price to earnings ratio, PE ratio, typically is a decent, good indicator. Maybe not in this market because it's so manic, but historically is a good indicator of what the fair value of the price to earnings ratio within of companies within the S&P 500 should be. Okay, again, from a historical perspective. That's why this video is focusing on the zoom out. We got to zoom out here sometimes. Okay, everything did it like when we're seeing such volatility like we have the past couple of years. It's hard to zoom out and slow down and stay focused on the macro because the intraday price action is so hyper volatile. But the macro, ultimately, if you're a swing trader, if you're a longer term trader like I am personally, the macro is ultimately at the core of all trading. Okay, so right now the S&P, time of recording, late February, is 25.78. We'll just round that up to 26. Okay, times in the past, a few times in the past, not too much, not until the year 2000 when we saw the dot-com bubble and whatnot, have valuations gotten above 20. But over the past 20 years, I mean, I guess when you're talking historically, things are different. We're in a very different time now. Things are, I mean, that might as well have been the dinosaurs might as well have been walking around back here. But I understand times are different. That said, historical PE is, okay, The historical mean over recorded history of the S&P is about 16. The median is about 15. So the average here is roughly, you could say, 15 to 16. That's where historically the PE ratio of the S&P 500 should be sitting. Okay, that's the average. And right now we're still at 25. Now, will we get back down to 15? I don't doubt it. Once again, we're living in a different environment. We're living in faster times. The age of technology, that Moore's law, is increasing exponentially. So that changes things up as well when you're dictating how far out you want to price things. So that's different. But is 25, can you justify 25 at this moment? I don't think so. And just looking at this chart right here, as someone who looks at charts, you guys, we haven't really established this higher low yet. I do think that we need to get to at least this previous high. That's around what, 20, 23, 24, which is a few points down from where we're at 26. But honestly, just to see a full correction in this environment where once again, the Fed is on attack mode, okay? The Fed is coming in hot. The Fed is going to raise rates. And as I said in here, it's unjust, it's immoral for the Federal Reserve not to attack inflation almost to the lower and middle class of the country. So they're going to come in hot. And in an environment where rates are raising, what these companies earn, the revenue of these companies takes a direct hit when the dollar gains strength. Okay, that's macroeconomics 101 right there. Okay, so that's important to keep in mind. And I do think, just from a PE ratio perspective, to balance out before this correction's over, on top of all the technicals that we'll get into right now, the S&P does still need to see more downside and more of a reversion to the mean when it comes to the PE ratio. Okay, so do I think we see 15? No. Do I think we see 20? I think that's entirely possible. Okay, so let's talk about some technicals. Let's dive into these charts. Okay, so the S&P 500, once again, on the daily candles, is still looking pretty crazy. Just right off the bat, you guys, let's go to take a look at, move my fat head. In the past year, even after this correction, I guess we have seen the relief rally up until this point, but in the past year, we are still up 15.5% from where we were at 1 year ago, okay? And that does not match the state of the economy right now. Again, raising rates, the reason PayPal, the reason Facebook are tanking is because there's less capital flowing around. Consumer sentiment is lower. I have a bunch of friends in like the clothing industry, big clothing companies, multi-million dollar clothing companies that are telling me anecdotally that in their experience, consumption is way down. There's just less appetite for consumer goods, okay? Excuse me. I've been talking a lot today. But that's very important to keep in mind, okay? And when the economy, and I'm not saying like, again, Amazon just did decent in earnings, Google did as well. That's tech. That's not the overall economy. That's not consumer spending. And I do think that with interest rates rising, that may balance the economics a little bit, like fighting inflation and whatnot. But like, you can't say that as much money is being spent as it was a year ago, and we're still up a year. Again, a year ago from now, there was helicopter money flying around. Everyone was still getting direct deposits. Everyone was still on unemployment. And there was just more money, more reckless capital flowing into the markets and flowing into businesses, et cetera, just because people weren't earning that money. And when you don't earn your money, you're more reckless with the way you spend it, okay? And the thing is now, again, everything's corrected. Inflation is still hot. People have to go back to work. There's no more helicopter money, and people are more conservative with how they spend, as they rightfully should be. But the market has not reflected that reality just yet. So I do think that rationale has to kick back into the market, and I do think more downside is ahead. I think that it's reasonable at the very least to come back down to where we were a year ago. I mean, this is where we were. I mean, a year ago we were what, back? We were more back here a year ago, okay? So back here, we were at like 390. The SPY is currently sitting at 450. 390 was a year ago, okay? So actually, I wouldn't be surprised if we reverted to that, but I'll just go right here. So 400, I think the SPY has to see at least 400, revisit the high we saw back before this last correction, before that big old parabolic rally back in mid-March. And I do feel like it's a lot more likely than not that the SPY, prior to actually what makes most sense, going sideways, and then over time, over the span of months, years even, will start to go sideways and then begin its climb back to the upside once the economy kind of just once it finds balance, and then once it starts to reestablish itself. Like 10 years from now, SPY, will it be higher than it is now? Absolutely. Will companies be greater than they are now? Absolutely. I believe in that 100%. But has this market been absolutely inflated since the Black Swan event that was COVID in March of 2020? Absolutely. If you just look at that, that's not an organic chart by any means, okay? So that's important to realize right there. And that's where I'll get into also this purple line, which is going to be the very macro trend line. So at the very least, I do think the SPY will see us get a quick price range here from current levels. I do think that 400 needs to be revisited. That would take us down 12% from where we're at the time of recording at 450 once again. But I think the SPY will see at least 400 prior to going sideways for a while and then resuming its overall long-term bull run. And again, if we do coincide with what is this shorter term descending channel, just go short term real quick and then we'll zoom out and go long and then close out the video with the VIX. But daily Stokes, what they're doing right now, I don't like that at all. I don't like to see when they come up, come down, curl back to the upside, doing the double top on the daily Stokes, which is what like Bitcoin, Ethereum, a lot of other names, Mana Sand, a lot of names in the cryptocurrency market are seeing right now as well, which I don't like to see because historically that's not good news. When you see that double top on the daily Stokes and then curl to the downside, that's usually followed by a pretty big move to the downside. So bearish as well. But when we zoom out here, I want to take a look at this very, very significant macro trend. As you can see here, the SPY, long-term, massive megaphone channel dating all the way back to February of 18. High, low, boom. Since then, very, very obvious megaphone channel. Megaphone, obviously, because it's going like that. Ascending channel, nice and perpendicular, but megaphone channel, boom, okay? So I do think that if we do come back, test this previous resistance, okay? TA101, previous resistance becomes new support. If we do come back and test this previous resistance as new support, that would take us down at the same time, that we test the line of support on the short-term descending channel right here. February 25th, that would take us to exactly 390 or where we were at a year ago, okay? So that makes sense to me, you guys. Again, in this, considering all the macroeconomic headwinds are here, this makes perfect sense to me. And I would not be surprised at all if we see a 390 SPY by month's end, okay? So, again, let me know in the comments down below. Sorry, haircut Royce. It's the first time in forever I've not rocked a hat. So, roast me in the comments down below. But, yeah, let me know what you guys think about this. Let me know if you agree or disagree with my bearish sentiment and my rationale. But as always, let me know why. If don't just say this is whack. You gotta rationalize yourself, all right? You gotta explain your reasoning. Okay, so let's close it out with the VIX real quick. So CBOE Volatility Index. Again, this is part 2 of the newsletter. Hook your boy up. Go sign up. If you're not signed up, what are you doing? Although the VIX has cooled down over the past week or two, I still believe that another wave to the upside is mounting on the horizon. It's not uncommon for the VIX to see 40 plus during hyper volatile periods, and we see those every couple of years. The biggest jump you can see on the chart below is the Black Swan event, obviously the pandemic. Around this time 2 years ago, where the VIX shot all the way up to near 90. Now, I don't think that's likely to happen again this time around, but I wouldn't be surprised to see a 50 plus VIX upon this correction, considering the S&P 500 just experienced one of the most manic rallies of all time. The higher you climb, the harder you fall. That's market physics 101. This is obviously good news for VIXY, UVXY. Hold in tight until we see them come to fruition, okay? So, again, you guys, if you want to know my exact calls, my exact puts, how I'm shorting the market, that's also in here, of course, as well. Just last shout out right there. Let's take a look at the VIXY and close it out. But again, let me know, just what do you guys think? What do you guys think? Let me know in the comments down below. Curious. Okay, so let's go to zoom out on the VIXY. So as we can see here, the VIX did just pop up. In this past week, played that well. I'm not playing it well because I'm still holding, but wrote it up, riding it back down. That, you know, builds characters, I've been saying. That's just the game. That's the nature of the markets. But came all the way up to 39, almost tested 40. And again, in the wake of this macro, I wouldn't be surprised to see it test 50. When we see back in February of 2018, when the markets were definitely seeing a hiccup, you can see the VIX did come all the way up actually to 51 here to test the top side. But I do think that we need to come up and test at least 40. So we came up to 38, 39. I don't think that's enough because I do think the equity markets are going to fall pretty damn hard. Again, Facebook, obliterating $250 billion from its market cap in a single day, in a single after hours trading session. That's the first time in history that's happened. This is a dirty market. This is a gnarly market environment. And this is when you see moves like this. I remember both of these pullbacks in the equity markets. They weren't this bad. There weren't moves this gnarly. Okay. And this is a gnarly environment. Again, harder you climb, the harder you fall, I do think. And the harder you fall, the more volatility. That obviously is directly correlated with the amount of volatility you see. And when you see that very stark, very heavy downside, that's when you see, like we saw in the COVID pandemic, this right here where the VIX jumped 366% from where it gapped up from a low of 1270 to a high of 85. Okay. So when things get crazy, that's what can happen. Do I think we're going to get back up to 85.90? Absolutely not. But do I think we can get up to 45.50? I absolutely do, and I actually think it's more likely than not, okay? So just wanted to give you guys my 2 cents on the VIX. Again, if you are short the market personally, if you believe there is more downside ahead for the S&P 500, you can pick up ETFs that trade against the VIX. Last plug, why not just close out the video? Again, if you want to know how I'm trading, if you want to join the newsletter family, it's much appreciated, and again, I feel it's very worth it. So that link's down below. Again, let me know in the comments down below as well what your thoughts are about the general market, about the macro, and also I will be going to Super Bowl, taking the family and the lady to Super Bowl. Freaking LVI, I'm so pumped. Obviously going for the Rams. Super pumped. My dad's hometown in SoFi in LA. I mean, I couldn't be more pumped about that. So, again, I will not be making nearly as many videos. I don't know if I'll even make videos up there. Probably will try to bang one out, but we will see. But, you know, I'll be writing this bad boy every single morning. I'll still be trading every morning, and I'll keep you guys posted with some charts in the newsletter, part 2 of the newsletter, and part 1, obviously explaining myself and the macro as well. So, I'll call it there, you guys. Also, see you downstairs in the comments. If you haven't commented already, go let me know what you're thinking, and I'll see you downstairs. Okay, so until next time, always remember, guys, take action, make waves. Peace.